Now, as we got to know the cleaner companies well, and this was say 2012, 13, 14, 15, right? We met the cleaner 80 companies again and again, spent quality time with them. We realized there's a further bifurcation. And the bifurcation is that even with many of the clean companies, whilst they're nice people, they're not stealing, but they're incompetent, right? They don't know how to run businesses successfully, and there's a lot of ego involved, status, prestige. They try to create empires, try to get jobs for their sons and daughters so that the next generation is looked after, and so on. And what that does is it reduces the return on capital, right? Return on capital is really the fundamental metric which drives wealth creation. Return on capital, in simple sort of jargon, is operating profit of a company divided by how much capital promoter G has put into it, right? So operating profit divided by kitna paisa promoter G has employed in that company. So the money that he's deployed is, say, factories, machines, plus the working capital, and plus some cash in the bank, right? So return on capital tends to suffer when the promoter doesn't have a practical mindset towards capital allocation. So what we said was, and we early on, around 2014, 2015, we figured this out, and that really drove the Unusual Billionaires, at 2016 blockbuster. What we said was, we won't invest in companies where the first para of this slide doesn't hold true. We're looking for companies where return on capital is in excess of cost of capital every single year, 10 years in a row. We want to see return on capital above cost of capital. Now, let's assume for simplicity, cost of capital is 15%. We want to see cost of capital above, we want to see return on capital above 15% every year, 10 years in a row, right? So once you apply this filter, the list of 80 clean companies comes down to 30. So 80 clean companies, but 30 companies which are clean and have good capital allocation. Then for 4, 5, 6 years, we just looked at those 30 companies, trying to understand how is it that these people make so much money? Why is it that these companies' return on capital is so far above cost of capital, right? Because remember, in a competitive economy, competitive pressures keep pushing down the return on capital. The competition comes in, cuts prices, offers new products, technology changes. Honestly, with great companies, you expect to see ROC, return on capital, go down. But with a handful of franchises, around 30 in our country, if we found that return on capital keeps actually going up, right? Decade upon decade, return on capital keeps stepping up, right? So we got very interested, very intrigued by this, right? And we spent a lot of time thinking about it. That's honestly how those books came about, Unusual Billionaires in 2016, and then Diamonds in the Dust tomorrow. The second half of Diamonds in the Dust focuses now on what I'm going to talk to you about, which is, why is it that in our country, a handful of companies, 10 to 20, they basically now account for the entire nation's profits, right? So over the last 30 years, our economy has got polarized. A handful of companies, 10 to 20, account for the entire country's profits, and they are basically the compounders for you and me. If you don't invest in these companies, if I don't invest in them, you can forget about the stock market. You ain't going to make money, because these companies now run the country's economy. They own the country's profits, right? So if you look on the chart on the left, you can see this process has been happening for a while now. So early 90s, when the economy got opened up, the top 20 profit generators accounted for just, say, 17%, 17%. Around the time my colleagues and I rocked up in India, 2008-9, the top 20 franchises accounted for, say, 25% of the nation's profits. Just before COVID, 2019, the top 20 franchises accounted for 2/3 of the nation's profits. And today, 15th August 2021, the top 20 companies in India account for a staggering 90% of the nation's profits, right? As I said, these companies are basically dominant franchises. They run our economy in many different ways. Now, why is that? And how can you make money from it? So just to quickly get into the why and how. If you look at the slide if you look at the table on the right-hand side, what you'll see is that basically our country is the world's most monopolized economy. Pretty much every sector whose products you and I use on a daily basis, you'll notice that either one company or at most two companies take home 90% of the nation sector's profits, right? So just to take a simple example, wherever you are in India, go to a local supermarket and you'll see the entire luxury biscuit shelf is basically one company, right? Everybody knows about that company. It's called Britannia, right? They're most profitable, and I reckon the world's most profitable biscuit is called Good Day. It's a staple of many Indian households at tea time. Same supermarket, staying in the same supermarket, you'll notice that the economy biscuit market, the mass market biscuits, are also one company. It's called Parle, right? Crack Jack and Monaco and Parle G. If you add up Britannia and Parle's profits, that's pretty much 85% of the biscuit industry's profits. And as I'm sure many of you know, right, with Britannia being a luxury brand and Parle being a mass market brand, the two firms they seldom compete with each other. So what you have is Parle is dominant in mass market, Britannia is dominant in the luxury segment. And this obviously has enormous ramifications for the wealth of their promoters, their shareholders. So in Britannia's case, it's listed. You and I can roughly do the math on it. I reckon the promoter family would be worth north of $5 billion there. In Parle's case, they're unlisted, but you can dig out their profitability data from the Ministry of Corporate Affairs and apply the maths. I reckon the biscuit part of the Parle family, I'm not referring to the distillery part of the family, the biscuit part of the family, I reckon will be worth anywhere between $2 to $3 billion, right? So $8 billion of wealth there. And the same story, really, whichever of these companies you want to talk about, same story. The paint industry, for example, 85% of profits go to Asian and Berger. And if you add up the wealth of the promoter families, it's 20, 21, $22 billion, right? So the average return on capital of a dominant monopolist, right, whether it's in cooking oil or hair oil or cigarettes or adhesives or bachcho ka doodh or glass lined reactors or air compressors, a dominant franchise in India, the average return on capital is 45%. Right? Remember, I told you 70% of Nifty companies can't even cross 15. And the average Indian dominant player makes 45%, right? A lot of people in our country jump up and down about, Facebook, Apple, Netflix, Google, Microsoft, Goldman Sachs, Toyota, Sony, depending on, people's predilections. They have a great fancy for Western stocks. But if you look at the world-class companies outside India, if they get to 20%, the company's CEO becomes a hero. In our country, honestly, the monopolist families don't step out of their house for 20% return on capital. They'll send the driver to run the business. 30% return on capital is the basic ask of a dominant Indian franchise. And those are the franchises you and I are interested in. Why are we interested in these franchises with 40-45% ROC? The answer is, for any company, whether our host today or say Mukesh Ambaniji's empire or the Murugappa group in Chennai or Little Marcellus, for any company, the amount of cash the business throws off is equal to return on capital minus cost of capital. This is the simplest and most important equation to understand in finance, right? Return on capital minus cost of capital is the cash the business will throw off, right? 45% is the return on capital of an Indian monopolist. 15%, let's assume, is its cost of capital. Free cash flow, therefore, the cash thrown out by the franchise is roughly 30% of capital employed.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.